Hello, and welcome back to Forex School from Pip Insight. This is Course 14, Risk Management, and it is the capstone of everything we have built together because it is the one course that decides whether you are still trading next year. Here is the roadmap. We start with the drawdown maths, and why a loss always costs more than it looks. Then the 1% rule and position sizing, real arithmetic, worked through twice. Next, the asymmetry rule, and the surprisingly low win rate you actually need. We will play stops where structure lives, name the 3 account killers and their antidotes, and agree a drawdown protocol for the bad weeks. Then we walk a full month of 12 trades, candle by candle, and close with the honest chapter about what risk control cannot do. Everything here is education, not financial advice. Notebook out, this is the one to take seriously. Let's begin with the mathematics nobody shows beginners, the reason professionals talk about defense before they ever talk about entries. Losses and gains are not symmetrical, and the difference is bigger than you think. Here is the asymmetry at the heart of everything. Lose 10% of an account, and you need 11% just to get back to flat. Lose 25%, and the road home is 33. Lose half, and you must double what is left, a 100% return, the kind professionals would celebrate as a career year, just to repair one bad month. Make it concrete, a £10,000 account slides to 5,000. To see 10,000 again, that trader must now produce the single best run of their life, with a damaged account and damaged confidence. The hole deepens faster than any shovel can work. That is why risk comes before strategy. The maths punishes large losses out of all proportion to small ones. A quick word on reading this chart, it is not a currency pair, it is an account. Each candle is one trade's effect on equity, and 1.00 on the axis is the starting balance, call it £10,000. 2 early winners lift it to 10,700, and our trader concludes he is talented, so he sizes up. Now watch the staircase down, each loss bigger than the last as he doubles his stake to win it back, until the 7th trade leaves him at 7,100. Then the arrowed candle, one enormous, furious position, and the account lands at exactly 5,000. Half gone, in a single decision. From there the maths demands 100% just to break even. Instead the curve bleeds out at 4,200, needing nearly 140%. No strategy failed here. The sizing did. So how do traders stay out of that hole? With one boring, beautiful rule, never risk more than 1% of the account on a single trade. Let's turn that sentence into arithmetic you can do in your sleep. The 1% rule says, whatever this trade costs if the stop is hit, it must not exceed 1% of the account. Getting there takes 4 numbers. 1. Account balance, say £10,000, so the risk budget is 100. 2. Stop distance, suppose structure puts the stop 25 pips away. 3. Pip value, on a standard lot of a pound-dollar style pair, call it £10 per pip. 4. The answer, lot size equals risk budget divided by stop distance times pip value. 100 divided by 25 pips times £10, that is 100 over 250, gives 0.4. We trade 0.4 of a standard lot, and if the stop is hit we lose £100. Exactly what we budgeted. The stop sets the size, never the other way round. Let's run it again with different numbers, because this only becomes yours when you can do it half asleep. New account, $5,000. 1% gives a risk budget of $50. This time the chart puts the stop 20 pips away, and pip value on a standard lot is $10. 50 divided by 20 times 10, 50 over 200, is 0.25, a quarter of a standard lot. Now notice the machinery working. Had the stop needed to be 40 pips instead, the size would halve to 1/8 of a lot. Wide stop, small size, tight stop, larger size, and the cost of being wrong never changes. That is the whole point of the rule, every losing trade takes the same 1% bite, so no single trade can ever hurt you. Here is what 1% looks like on an equity curve, same reading rules as before, each candle 1 trade, 1.00 the start. 12 trades, 6 winners, 6 losers. A coin flip, near enough. Trade 1 loses and the account dips 1% below the line marked on the chart. The deepest moment of the whole run is 2 losses in a row, and even then we sit just 1% under where we began. But every winner is taken at 2 to 1, so it puts back double what any loser removes, and the curve grinds upward, back to break even, then ahead, finishing at 1.06, 6% up while winning only half the time. Compare this to the blow-up chart from a moment ago. Same market, same coin flip luck, completely different survival story. Boring, steady, and still in business. That equity curve worked because of a second rule hiding in plain sight: every winner paid double the risk. This is the asymmetry rule, and it quietly rewrites the win rate you actually need. Let's speak the table out loud, because it changes how you see every trade you will ever take. If your winners are the same size as your losers, 1 to 1, you must win more than half the time just to stand still. At 2 to 1, break-even drops to 33%, 1 win in 3 keeps you level. At 3 to 1, 1 winner in 4 is enough to survive. Now run 10 trades at 2 to 1 with a 40% win rate. 4 winners earn 8 units of risk, 6 losers cost 6, you finish 2 units ahead while losing most of your trades. That is why this framework declines any setup that cannot reach twice its risk before running into obvious structure. Asymmetry buys forgiveness for being wrong, and forgiveness is what a learning trader needs more than anything else. So where does the stop actually go? Here is the principle: a stop loss is not a pain threshold, it is a statement: if price reaches here, the reason I entered is gone. That means it belongs beyond the structure that justifies the trade, below the swing low that makes an uptrend valid, above the swing high that makes a short make sense, with a small buffer because wicks hunt the obvious level. What it must never be is a tidy round figure. 20 pips because 20 feels neat, or £50 because 50 sounds sensible, places your exit at a price the market never agreed to respect, and the market is the only party being consulted. Chart first, distance second, size last. Always in that order. What's the order of operations on a real shape? An uptrend climbs from 126.50 and stalls at 127.52. The pullback then builds a shelf. Look at the lows, 126.76, and the candle marked retest dipping to 126.78. Structure says buyers defend this shelf. Entry comes as they step back in, around 127.12. Now the stop, not 20 tidy pips, but below the shelf and beyond the wicks, the gold line at 126.72. That is 40 pips of risk, so on our £10,000 account the formula gives a quarter of a standard lot. And notice the market never touches it, the deepest wick holds 6 pips above the line, the trend resumes, and the 2 to 1 objective at 127.92 is tagged on the final candle. The stop lived where the idea died, nowhere else. Every rule so far can be undone in one emotional evening. Meet the 3 account killers: revenge trading, moved stops, and the swollen head, and the antidote rule that neutralizes each one. Killer 1, revenge trading. A loss stings, and the brain demands the money back immediately, so in you go again, bigger, on a worse setup. The antidote is mechanical: after any loss, a mandatory pause away from the platform, and the next trade must pass exactly the same checklist as the first. Killer 2, moving stops. The moment you drag a stop away from approaching price, you have swapped a planned loss for an unplanned disaster. The antidote: the stop is set at entry and may only ever move in your favor, never away from price. Killer 3, oversizing after wins. 3 winners in a row whisper that you are special and deserve double size. The antidote: size is calculated from the balance, by the formula, every single time. Mood is not a variable in that formula. Here is Killer 2, frame by frame, the true price of moving a stop. A trader buys the bounce at 127.56, stop tucked below the swing low at 127.24, the white line at 127.18, 38 pips of planned risk. Price sags. As it closes in on the line, the trader blinks and drags the stop down to 126.90, the red line. Look what happens next, the market trades straight through the original level. The plan said pay 38 pips and leave. Instead, the moved stop is hit on the arrowed candle at 126.90, 66 pips gone, nearly double the plan, and price keeps falling anyway, ending the chart at 126.30. Read that again slowly, the original stop was not the enemy. It was the cheapest exit on the entire chart. Even with perfect sizing, losing streaks happen. At a 40% win rate, 7 losers in a row is a matter of when, not if. So professionals pre-agree a drawdown protocol, written while they are calm. Rule 1, a daily loss limit, 2 losses, or 2%, and the platform goes off for the day. The market reopens tomorrow, your judgment will not recover this afternoon. Rule 2, the walk-away rule, when the limit is hit, you physically leave the screen. Analysis can wait, orders placed in that state cannot be trusted. Rule 3, when the account sits 5% below its high, halve the position size. Every loss now costs half as much while confidence rebuilds, and full size is only re-earned at a fresh equity high. 3 rules, agreed in advance, because mid-drawdown is the worst possible moment to negotiate with yourself. Time to put every rule on a single chart. 12 trades, 5 winners, 7 losers, a month most beginners would call a disaster. Watch what sizing and asymmetry quietly do with it. Read this like the earlier curves, each candle is one trade's effect on the account, starting at 1.00, £10,000, risking 1% a trade, every winner taken at 2 to 1. Trade 1, a loss. 9,900. Trade 2, another loss. 9,800. Trade 3, a winner, plus 2%, back to 10,000 exactly. Then the ugly stretch, trades 4, 5 and 6 all lose, and the account steps down into the shaded box, 9,900, 9,800, 9,700. Halfway through the month the score reads 1 winner, 5 losers, down 3%. And here is the point, under the protocol, that is annoying, not fatal. No candle on this chart is allowed to be worse than 1%. The trader is bruised, still following the rules, and completely still in business. Second half of the month, same rules, same chart. Trade 7, a 2 to 1 winner lifts us off the low, 9,900. Trade 8 gives 100 straight back, 9,800. Trade 9, another winner, and the account touches the white line, 10,000, break even, despite 6 losses already booked. Trade 10 wins again, 10,200. Trade 11 loses, 10,100. And trade 12, the final winner, closes the month at 10,300. Now add it up. 5 winners, 7 losers, a win rate barely above 40%, and the account finishes 3% ahead. Nothing heroic happened on this chart. The winners were simply twice the size of the losers, and no loser was ever allowed to grow. That is risk management doing, quietly, what strategy alone never could. Now the honest chapter, because this channel does not sell dreams. Risk management cannot create an edge. If a method loses money on average, a negative expectancy, then 1% sizing simply means losing slowly instead of quickly. No sizing scheme on earth rescues it. And the base rate deserves saying plainly, the figures regulated brokers are required to publish show that most retail accounts lose money. Most. That is the game you are choosing to study, and pretending otherwise would make everything else in this course a lie. What risk management genuinely buys is runway. It turns your inevitable early mistakes into affordable tuition, hundreds of small lessons instead of one fatal exam, and keeps you at the table long enough to discover, honestly, whether you have an edge at all. Nothing more than that. And nothing matters more than that. Let's carve the capstone takeaways into stone. The drawdown maths, losses compound against you, lose half, and only a double brings you home, so the first job is never to need one. The 1% rule, risk budget divided by stop distance times pip value gives the lot size, the stop sets the size, never the reverse. The asymmetry rule, 2-to-1 minimum, so 1 win in 3 keeps you level and 40% makes you money. Stops live beyond structure, at the exact price where the idea is wrong, and once set, they move only in your favor. Know the 3 killers: revenge, moved stops, oversize, and run their antidote rules without debate. Protect the bad weeks with a daily limit, the walkaway rule, and half size in drawdown. Survive first. Profit second. In that order, forever. And that is the capstone, not just of this course, but of the whole Forex School series. You can now read structure, trade levels, judge trends, and, as of today, size every position so that no single trade can ever end your story. That last skill makes all the others usable. The series is complete, and the entire library is free. Every course, from support and resistance to smart money concepts, is waiting on the channel, and the strongest move now is to revisit any of them with risk-managed eyes. They read differently once you think in 1% units. If Forex School has helped you, subscribe and pass it to the trader who needs it. One final time, because it matters most here, everything in this series is education, not financial advice. No method is a promise of profit, and trading carries real risk of loss, so practice on a demo until these rules are reflexes. Thank you for studying with me, from the first level to this last one. Class dismissed, and stay safe out there.